welcome to Top Growth Financial. I'm Josh, and Mitch will be taking over for me here in a second. This is our first video, and we're super excited that you're watching. We're just going to take you through a beginner's guide to the stock market. If you're new to investing, this video is going to be perfect for you. We're going to try to eliminate all those mistakes that new investors make and help you build up that portfolio over time. We're going to be giving our top 3 stock picks every week, so just make sure you stay tuned for that. And if you've been investing for a while, that's no problem. Hopefully you can still take away a thing or two from this video. And with that, we're just going to start from square one. What is a stock?
Okay, so what is a stock? Also known as a share, a stock is a fractional ownership of a company. So for instance, if you own 1 share of a company that has 100 outstanding shares, you would then own 1% of that company. Now, most companies, especially bigger ones, are going to have millions of outstanding shares, so that 1 share is not going to be a very substantial portion of that company. But all it takes is to invest even as little as $1, and you would be considered part owner of that company. So now that we know what a stock is, we're going to talk about how to buy stocks. For starters, you're going to want to decide on what platform you want to use. Some that I recommend are Robinhood, Fidelity, TD Ameritrade. Now, all 3 of those will be commission free if you use their online platforms. So if you walk into Fidelity and ask to set up an account, they're going to give you a broker and they're going to charge you a commission free. If you're confident that you can invest yourself, do the online and you won't get charged that commission. I use Robinhood myself. Josh does as well. We both really like Robinhood, but all 3 of those are good platforms. So now we're going to show you how to actually buy the stock. And for this example, we're going to use Robinhood. Okay, so as you can see here, we brought up Amazon for our example. What we did was we just came up here to this search bar, searched Amazon, and then clicked on that name, and then it brought us up to here. This is the chart for the day. You can see, hover over it, show you, and then here you can look at the weekly, the monthly, and all that. Okay, so when you go to buy, you can see buy Amazon up here. You can either invest in dollars, or if you click on this, you can also invest in shares. So if you do shares, then you can only buy in a whole amount of shares. So you can do 1 share, but that's going to cost you down here $3,200. So say we don't want to invest that much, we're going to buy in dollars. And you can even go as little as $1. You see that'll give us 0.0003 shares of Amazon. So after you've done that, you just want to click on review order here, and then come down here and then just click on buy, and then you have now successfully placed an order to buy Amazon shares. Now that we know how to invest, Josh is going to talk about the different types of investing.
So when you're investing long term, you want to make sure that you're putting your money into the right place and that you're diversifying. And what I mean by that is just checking out the underlying intrinsic value of that company, making sure it's worth putting your money into, and then diversifying. Don't put all your money into a single company because you think it's a great company. Maybe it'll go up, but it might also go down, and you could lose a lot. Also, having a variety of stocks in your portfolio is going to help cushion the loss of the stock that doesn't do as well, that doesn't perform good. If the stock just drops rapidly, but the rest of your portfolio is performing quite well, you're not going to notice that loss as much. And Mitch is going to show you exactly what to look for next. Like I said, we're going to be doing a lot of research for you guys. We're going to be giving you the best stock picks, in our opinion, every single week, so that you guys don't have to do all that work yourselves. We're going to take a lot of that off your hands. But if you wanted to take a more passive approach to investing, you could just put your money into an index fund. It takes no work, no effort. You can put your money in, not think about it, sit back and let the money roll in. For the long term, it's been pretty solidified that if you invest in an index fund, that you're going to get a good return of about 8 to 10% over the long run. Maybe 1 year it goes down, the next year it goes up, but the average is about 8 to 10% per year. You could also invest into a mutual fund, but you're going to have fees with that because it's professionally managed. Also, a new really exciting type of investing is an ETF, and this is an exchange traded fund. These are cool because it tracks a sector and it can be traded just like a normal stock. Also, you can invest for dividends, And this approach is one that me and Mitch have been taking for a while because you're getting passive income from these companies. A dividend is just a payout of their earnings per quarter, and their ability to pay a dividend is actually such a good sign. If you see that a company could pay their dividend consistently over the past 5 to 10 years, that's going to be a great investment for you, and that's really going to pay off. But if they haven't been paying their dividend consistently, I would probably say turn away from it, because it's probably not going to give you the results that you want. So Mitch, what should we be looking for in a stock?
First off, you're going to want to search investor relations followed by the name of that company. This will give you a full breakdown of the company's charts, their numbers, their quarterly and yearly earnings, plus a lot more. For starters, you're going to want to look at, is the company profitable? If they're a newer company, they might not be making a lot of money right now, or they could even be in debt as of right now, but you want to look at, are they becoming more and more profitable each quarter or by year? Another key factor in a successful company is a good return on capital. And what that is their net income divided by their invested capital. That's going to come out as a percentage. And what that tells you is how much a company profited compared to how much they actually invested into their company. So if I told you a company profited $100,000 last year, but they invested $10 million, that doesn't sound as good as just saying a company profited $100,000. So usually a good return on capital is going to be between 15 to 30%. Another thing you want to look at is the company's PE ratio, or price to earnings ratio. And what that is the company's current stock price divided by their earnings per share. So you want to look for a lower PE ratio, about 8 to 25. A lower PE ratio means that the company's stock price is pretty low compared to their earnings. So if that's the case, that would mean that they're reporting good earnings, they're making good money each quarter, but their stock price hasn't reflected that yet. The longer you wait, it's bound to happen. If they continue to report good earnings quarter after quarter, that stock price is bound to go up eventually. And lastly, what you want to look at is the company's debt. Now, most companies do have debt. A lot of times it's needed in order to grow a healthy and successful business. What you want to look at is how much, and you also want to look at their cash flow. So is that company bringing in enough cash flow per month to continually pay off that debt? If that is the case, then don't be worried. Don't let that scare you away from that company. But what would be alarming is if that debt is higher than the cash flow they're bringing in per month, because that will tell us that they're probably not going to be able to pay off that debt anytime soon. If you can see that they're probably going to be able to pay off their debt within the next 3 to 5 years by looking at their cash flow, then that's actually a pretty good sign. It shows that they're still making money while paying off their debt, and eventually they'll be debt free and they'll just be able to dump even more money into that company and let it grow and grow. So now we know how to pick a stock that'll make us money. But with profit comes taxes. Now Josh is going to give us a breakdown of how those taxes work.
So, when you sell an asset for more than you paid for it, the result's going to be capital gains. And those capital gains taxes are going to be taxed based on the amount of time that you held that asset. So if you hold it for less than 1 year, it's going to be taxed like your ordinary income, which is generally about 20% for the normal individual. But if you hold it for longer than 1 year, you're going to get a little bit of a break there, and it's going to be about 15% for that same individual. So I would definitely recommend, if there's no immediate need to sell that stock, if it's not plummeting, definitely hold on to it for the long run. That's me and Mitch's strategy. And that's what we would recommend you do, because you're going to save a lot of money in the long run. Okay, so that's it for this video. We're glad that you watched, and we hope that you punch that subscribe button, that you stay tuned. We're going to be giving our top 3 stock picks every single week, and just make sure you tune in. It's going to be some great stuff, and we hope that you learn a lot.